Well, hello, this is Bob Woosley, National Private Equity Practice Leader for Frazier Deeter's Private Equity Practice. I'm here today with Bryce Nations, one of our senior tax partners in our private equity tax group. And Bryce, we're going to be talking about the new tax law today and how it may or may impact the private equity and real estate fund industry, where we, as you know, we're pretty involved. But first of all, tell us a little bit about yourself, Bryce, and your background, and then we'll go right into it.
Sure. Excited to be here today. I've been with the firm a little over 12 years, all on the tax side. Prior to that, was with a smaller firm for about 2 years. Most of my practice is centered around private equity and real estate. So I'd say probably 80% of my practice is tied back to real estate somehow. In regards to the new law, it's going to be sort of very broad. It's going to affect, every type of taxpayer. And when you talk about, private equity and real estate, one of the first things that kind of pops out in the bill is some of this carried interest legislation that they've passed.
Right.
And I think they've talked for a long time about trying to do something about carried interest, and you've probably seen it in the news, you've seen it in print, on TV, and at the end of the day, what they're really trying to attack is sort of, the Wall Street version of a carried interest. Mm-hmm. It's not necessarily their intent to go after sort of closely held, corporations that are trying to just reward key employees. Although it looks like this new law might also wade into those waters as well.
Right.
I think broadly speaking, there's a lot we don't know about this law in general, but especially in regards to this carried interest piece.
Right, and that's what you and I were talking about when you did that live presentation that I attended. And one reason we invited you to this podcast is that you were expressing that there were still some open points as it relates that need to be nailed down. Now, our audience, as you know, are mainly controlled buyout private equity funds and real estate funds. But can we just back up a step and for some of the listeners, just define what carried interest is? A lot of people think they know what it is, but they may have the wrong
Sure.
idea. But can we go to the basics, maybe talk about how the old law treated things and how you think it might be treated under the new law?
So sure. If you want to back all the way up,
Yeah,
I guess
let's do that. Okay.
There's two different ways
Right.
to kind of think about a partnership interest. So
Okay.
you can have a profits interest, which basically entitles you to some type of future profit on some type of future event.
Mm-hmm.
So it's not currently fixed and determinable. So I really don't know what I'm going to get in the future, basically. And then you have your standard partnership interest, which most people would call it, and that's a capital interest. And that's where I've given cash or property in exchange for a partnership interest. So I have equity, I have skin in the game already from day one.
Mm-hmm.
And so the difference between the two is that one I can sort of place a value on, and it's fixed and determinable. And so that's what the IRS and the court systems have kind of looked towards to determine the type of partnership interest you have. And if you're unsure, run through sort of a hypothetical liquidation of the partnership and say, if this thing liquidated right now, would I be entitled to anything that's currently in it? And if the answer is no, then you probably have a carried interest or a profits interest.
Mm-hmm.
And so you would potentially be affected by this new law.
Mm-hmm.
Now, under the old law, since you couldn't really place a value on that profit or carried interest, because I don't know how much I'm going to make on it, if we sell the underlying asset or the company or securities or whatever on down the road, I don't know what that value is going to be. And so because of that, the IRS basically agreed and said, well, okay, there's zero value on day one to a profit interest.
Mm-hmm.
Now, a capital interest, if I grant you that as an employee or as a service provider, I can place a value on that because I'm basically saying that, one day later, if we liquidate the partnership, you're going to get something and you're going to get it proportional to the amount of capital that I'm giving you.
Mm-hmm. So why was this such a political hot button? I mean, going into the law when it was in committee and all, everybody, and when Trump was campaigning about it, it was all about we're going to get rid of carried interest. I mean, why do you think this is so controversial?
Right. So the idea behind the whole thing is that as a service provider, you can take a carried interest in a partnership that you're providing services for and convert what would most people would argue is probably ordinary income to you, or service income, or income in exchange for your services, for capital gains on down the road.
Right.
And so the new law and everything you hear about in the media is trying to stop that, basically converting what everyone else would pay, ordinary tax rates on as ordinary income from just their job, converting that into some type of a capital gain, which would be taxed at a much lower, more favorable rate.
Okay, now I think that's the simplest way I've heard to really understand the drivers behind this thing.
Right.
So old law, mainly it was converting what could have been ordinary income into capital gains, and probably wouldn't you say most of our private equity funds we work with took advantage of that, and rightly so. I mean, in terms of the carried interest provisions. So what's happening now? What are the what does the public think is happening? What's really happening?
So flash forward to this new law.
Right.
So anything after January 1, 2018 falls under the new law. And what they're really trying to do is target these carried interest. Mm-hmm. And they're doing it without really changing the law on the carried interest. What they're doing is they're just adding to it. So now they're saying you can still have this carried interest, but you're going to have to hold it for at least 3 years.
Okay.
So if you want to kind of play the game, then you got to at least hold it for 3 years. And they've got some other provisions as well that they've tossed in there, trying to cut back on the potential abuse even under that new 3-year hold period, saying, well, look, if you've held the interest for 3 years, it qualifies. But if the underlying assets inside the partnership haven't been held for 3 years, then
so there's some nuances. I mean, is it 3 years starting retroactively from when you held it, or is it?
So it appears that there's not going to be any type of grandfathered provision. So it's on any gain that flows through to you as a service provider holding a carried interest past January 1. So it doesn't matter
even if you held it,
even if you already had the agreement, even if you've already held it for a greater than a year. So under the old law, if you had held it for at least a year,
you had capital gains.
You had capital gains.
So there may be some of our clients and our friends in the industry that may have had a carried interest under the old law. Say it's June 2017. They may think, if they held it to July 2018, they were going to have capital gains, and all of a sudden that's off the table.
It appears that there is no grandfather provision. So yes.
Is there any difference between real estate funds and private equity? I mean, regular control buyout are good old private equity firms that are just buying companies.
Right.
Can you speak to that a little bit?
That's kind of been part of the confusion.
Okay.
And so it's actually written into this provision, and it's also in the internal committee reports that advise the Treasury Department to actually come out with new rules and regulations regarding who's going to actually be affected by this. And so I think we're going to have to wait to see some further guidance on this. But I will tell you that there is somewhat of an argument out there for, I won't say for, amongst practitioners that are saying, look, this only applies to capital gains. So think any type of portfolio income. So think like gains from securities, hedging transactions, commodities, things like that.
The normal capital gains.
The normal type of capital gain stuff.
Okay.
Now, that being said, there is a part in this new law that specifically says real estate held for investment or rental use will fall under this rule.
Okay.
However, you'd have to have gain under rental real estate or real estate held for investment for this to apply capital gain. So some people are taking the position that, well, what I have in my typical real estate fund is not a capital gain. I have what's called a Section 1231 gain.
Which has been around forever.
Right. And that's gain from business property, essentially.
Okay.
So I'm engaged in trade or business and I sell an asset, a building, land, whatever. I have Section 1231 gain as long as I've held it for a year. So the argument is, that might not have been their intent when they wrote the law, but that's kind of the way if you take a literal reading of it, if you think of a Schedule K1 that you get, right?
Right.
If you sold a high-rise office building, what would most likely flow through and should flow through is Section 1231 gain, not long-term capital gain in the other box.
Okay.
So the argument is if it's not in that long-term capital gain box, it shouldn't count under this law.
So if it's Section 1231 gain, okay, let me make sure I've got this right. That's actually better if they interpret it that way than getting caught in this new rule where
Absolutely.
it becomes ordinary. Because Section 1231, if I remember my tax all right, has some capital gain attributes to it, correct?
It's taxed as a capital gain, but
Right.
it's not defined as a capital gain.
Wow.
And
Okay.
the code section that they reference in the new law points you back to sort of investment capital gains.
All right.
Versus this business use capital.
So when you say some practitioners are thinking about that, is this part of the thing that might get clarified later, or do you think we might slip in under the wire on this? Not under the wire, but
I think
have
they're
an
going to
opportunity.
have to clarify it.
Okay.
Because there's clearly a reason why they included investment and rental real estate in the definition of a applicable business that
Right.
this would apply to.
Right.
So it looks like that could have maybe just been an error in the drafting, but I think it's
I can't imagine them making an error like that, right?
Yeah, that would
Right.
never happen.
Never happen.
Never
Correct.
would that ever happen. Right?
So with your real estate fund clients, not fund, but fund clients, that's something they ought to be thinking about and at least measuring the odds.
I think so, yeah. And one other area that's sort of been up for interpretation, with this is there's two exceptions to the new rule. So one is if you hold the interest as a corporation, this rule doesn't apply to you. Or if you contributed capital and you share pro rata in the items inside the partnership, profit, loss, pro rata proportionate to the capital that you put in.
Right.
So the second rule sort of goes back to capital versus profit interest like we talked about before. If you put something in, you have equity, you have skin in the game. The corporate rule, though, could be interpreted several different ways. And so one of the ways that you could read that is it means C corporations, right?
Mm-hmm.
Like large corporations that hold these interests. This law doesn't apply to them.
Okay.
The other way you could read it is any type of corporate entity. So you could read that as an S corp. So what some people are sort of pondering now, some of my fellow practitioners, is do you form an S corp and hold your carried interest in the S corp, and then this rule doesn't apply to you?
Would that work for a fund, though? I mean, because the funds are usually LLCs or partnerships, right? I mean,
right.
Yeah.
It would depend on the particular fund.
Yeah.
And how they wanted it structured.
Okay.
But I mean,
but something to think about.
And who the owners would be of the S corp, because you have ownership limitations on that, on who can be an owner of an S corp. But it's a potential thought at least.
Well,
sure.
we certainly see on the private equity side, from my practice, we see a lot of people doing single purpose or special purpose entities that might be under almost like a feeder fund structure where you have one like maybe say you have 20 single purpose entities holding real estate with a master on top of it, but all those, it sounds like we need to look at those, right? Because those maybe could be S corps down at the bottom.
Well, really what you would want is you'd want an S corp at the level where you hold the carried interest.
Carried the interest.
So
okay.
Not necessarily at the property level.
Right.
Right. But yeah, I mean, it's definitely time to kind of revisit those structures. And what some people are thinking about doing, I've had some clients that have commented that they're going to go ahead and form LLCs. And then if they need to try to convert the LLCs to an S corp down the road in a couple months, they'll go ahead and do that once they get more clarification.
So kind of a defensive posture,
sure,
just in case posture.
Right.
All right. So I bet you some of your clients are thinking about these strategies right now. Is there anything else? This has been good because for our listeners, a lot of my listeners here, or our listeners, are not as technical as you are. Thank goodness, Bryce. But is there anything else about the law that they should be concerned about? I mean, obviously exiting portfolio companies or exiting underlying assets. Sounds like the main thing is the carried interest, and there may be some opportunities to plan around that. Is there anything screaming out at us that we need to know in this podcast, or should we defer that to another one?
There's several other rules that could conceivably come into play that have come from this new tax law. There's a business interest deduction rule
Yeah.
that would apply if you have gross receipts in excess of 25 million. And so that's
It
something
limits your right.
Exactly.
Yeah.
So it basically limits your interest deduction that you get every year. It
Right.
doesn't make it go away. It just any amount that you're not able to take will roll forward.
Yeah. And that's where I know that we've done other podcasts, and I encourage the listeners to go access that about general business provisions under that law. Not as narrow as our conversation today, but yeah, I would recommend that people listen to that our other podcasts on that subject. Well, this has been great. I mean, is there anything else? I mean, I think what we just covered here are, at a high level, what carried interest is under the old law, now the new law, some nuances that are not quite settled yet. I guess the final thing before we wrap up, I mean, when do you expect guidance, and how does guidance come down the path on this stuff? Is it court rulings, or is it?
So everyone kind of passes the buck on this, right? So Congress actually writes into these laws like, okay, we expect the Treasury Department to come up with some type of revenue rulings or regulations to help taxpayers interpret these new laws. And so the IRS kind of says, well, yeah, we got a million other things to do, and we're trying to get ready for filing season. So
Yeah.
When we'll actually see something, any type of guidance, I think it'll be hopefully sometime this year. They've come out and said informally at a couple different conferences, some of the IRS chief counsel have come out and said, we think we're going to have in the next few months, we'll have some type of guidance on certain sections of the law. I don't know if this carried interest section is real high on
In the 1231 in real estate, maybe they'll miss that, right?
Right. I don't know.
Yeah.
So maybe for carried interest, we'll know something by the end of the year.
Okay.
There's a couple of other of the new provisions like the business interest and then the pass-through deduction, the 20%. I think we'll get more guidance on that quicker.
So that's why you're saying people are setting up LLCs just in case.
Yeah, because
you're not going to know.
It's going to be a while. Yeah.
I mean, it may be November or December, so
Right.
you have to make some educated guesses.
I mean, when was the last time the IRS was quick with
Never.
with anything, right?
Yeah, sometimes that works to our advantage.
Sure.
They're not quick.
Yeah.
Well, Bryce, this has been great, man. Thank you so much. I encourage all our listeners to feel free to contact Bryce. Our team really, they live and breathe private equity and real estate, so we're happy to have offered this. And Bryce, can we, set a date with you maybe 3 months from now to have an update on this?
Sure, absolutely.
Okay, that's great. Well, thank you very much, and everybody.
Thanks for having me.
Have a great. Yeah, you're welcome. Talk to you later.
This recording is for informational purposes only and should not be considered tax advice.